What's going on, my fellow wealth creators? Matty Ice here. In this video, I want to share what is probably one of the most misleading posts about whole life insurance versus index universal life insurance that I've seen in a long time. It reminds me of those posts and ads that you see sometimes where IUL agents are showing you how bad the 401k is and how much better the IUL is. It's extremely, extremely misleading. And it's meant to make one thing look really bad so that the other thing looks really good. And I'm sorry, but if you have to do that in order to promote what you're selling, you should probably be selling something else, right? You should be able to sell what it is that you're selling based on the merit and of the product, the value and benefits that the product provides. Now, I'm not saying that I'm not saying there's anything wrong with doing a comparison, but if you're going to do a comparison, make sure it's factual and accurate. Because what I'm about to show you is, like I said, it's incredibly misleading. So let's get into it. All right. Yeah. So I was going on. I was on LinkedIn, connecting with some people, having a couple of conversations, and this popped up in my newsfeed. And I was like, is this guy serious? So yeah, let's go through it. So he did a post comparing whole life insurance, which, of course, is just the worst thing that you could possibly do. And he's trying to show how amazing index universal life insurance. So let's kind of go down the list and let's break this down. Premium is fixed and the face amount is fixed. This is not true at all. So the premium is fixed. So you do have a level base, like a base premium, but here's how whole life, the premium inside of whole life insurance works is when you design it for high cash value, there's two places that your money goes to. It's the base premium and then paid up additions. The paid up additions is very flexible. You can pay up. You can pay all of the paid up additions in one particular year. You can pay half the paid up additions. You can pay no paid up additions. You're always on the hook for whatever the base premium is. That's the minimum amount of money that you have to put into your whole life insurance policy every year. So that part is fixed. But when you design it for high cash value, which you usually do with dividend paying whole life insurance, there is a lot more flexibility than people will often say. This is a perfect example of it. The face amount is fixed. So he's talking about the death benefit. Well, that's not true either. The death benefit in a whole life insurance policy, when you design it like this, not final expense. We're not talking about that. We're talking about dividend paying whole life insurance set up for high cash value. Your death benefit actually increases every single year because you're reinvesting you're reinvesting the dividends into more insurance, more paid up additions. That's part of the compounding process, the compound growth that a whole life insurance policy gets. So your death benefit, your face amount, is actually increasing every single year when you do that. So I have no idea what he's talking about here. And of course, right here, he says that the premium and face amounts are flexible for index universal life insurance. And this is always touted as a benefit. I don't see this as a benefit because the only reason the face amount would be, we'll talk about the premium in a second, but the only reason that the face amount, the death benefit of the policy being flexible would actually be a benefit is if your policy did not perform and you're forced to lower the death benefit in order to lower your net amount at risk so your policy doesn't blow up. But that means the policy did not perform anywhere close as it was illustrated. So I guess you kind of need that flexibility because a lot of index universal life policies are not going to do anything close to what they're illustrated for a number of different reasons. That's a separate video. But this is not necessarily a quote unquote benefit or an advantage over whole life insurance. And with regards to the premium, again, I would argue that the flexibility of the premium is not necessarily a good thing because if you don't fund an IUL properly, if you don't max fund your IUL, you're significantly increasing the probability of that policy lapsing, or at the very least, not performing anywhere near what was originally illustrated to you. So you have to max fund the IUL. So the flexibility of the premium being paid in an IUL, I would argue, is not nearly as good of a benefit as at least what's being shared here. The company, this is one of my favorites. The company keeps the cash value and only gives the face amount to the beneficiary. And that's just the dumbest thing that I hear people say about whole life insurance is that oftentimes it is said that the life insurance company steals your cash value. You hear that from Dave Ramsey a lot, which is not true. I've done videos on this, but essentially what happens is like this is not technically what happens. The life insurance company just writes a check for the death benefits, income tax free, goes right to your beneficiaries. Okay. But if you think about it, the cash value, so you have cash value and you have death benefit. All right. Let me blow this up here really quick. All right. So you have cash value and death benefit. All right. When you take the death benefit amount and the cash and you subtract the cash value amount, so death benefit minus cash value, that's what's called net amount at risk to the life insurance company. That's basically the amount of money that the life insurance company is actually on the hook for to pay out as a death benefit, right? So when you pass away, let's say you have $1 million death benefit, and let's say you have $500,000 of cash value. Okay, well, the life insurance company is just going to write a check for $1 million to your beneficiaries. Okay, this is where people say, well, or ask, well, what happens to the 500,000? Do they just keep that? They just steal it? No, it's part of the death benefit. The cash value supports the death benefit. So if you think about it, you have $1 million death benefit. What's happening is the life insurance company is going to give that $500,000 of cash value to your beneficiaries, but they're going to add an additional $500,000 on top of it to equal the death benefit that they are on the hook for. So do they steal your cash value? Do they keep it? No, it supports the death benefit itself. Now, when he's saying here that for IUL, the beneficiary gets cash value and the face amount together, I'm not really sure what he's talking about there. If that's like an increasing death benefit option. I think that's option B, I believe it is. But yeah, this is what really pisses me. I mean, there might be like a scenario or a design where you could actually get both the cash value and the death benefit. Again, that's a separate video. But this right here about whole life insurance is just incredibly misleading. It makes it sound like the whole life insurance or the life insurance company is keeping and stealing the cash value. No, the cash value is part of the death benefit. It supports it. Client pays premium until what? Until he lives? I don't. Maybe that's a grammatical error there. Or max 100 years, or if it is limited pay. So all that right there doesn't even make sense. Like if you're going to bash whole life insurance, at least make sense, please. But here's the thing: with whole life insurance, it's way more flexible. You're not. Then people say you're not paying, you don't have to pay into it for your whole life. It's going to be there for your whole life. It's going to grow for your entire life. But you don't have to pay into it for your entire life. You could do a 10 pay. Heck, I've seen people pay into it for 3 years. It depends on how you fund it, right? Like people will make premium payments for 3 to 5 years, never make another premium payment ever again. And then they do what's called a reduced paid up. And you never owe another premium payment ever again. Yet it's going to continue to grow for the rest of your life. You could do 10 years, 20 years, pay to 65, pay to 70, 75. It really just depends on what your goals are. Okay. But there's a lot of flexibility regarding how long you pay into a whole life insurance policy. So again, extremely misleading. Clients only pays, I mean, get your grammar right, man. Seriously. Clients only pays premium until a certain amount of time. I mean, it's not even specific, like a certain amount of time. Well, you could do the same thing in a whole life insurance policy. What are you talking about? And here's the thing, with indexed universal life insurance, again, if you don't fund it properly, that policy could blow up in your face later on down the road and not perform anywhere close to what was illustrated. And here's the problem with this statement right here too, that the client only pays premium until a certain amount of time. I've seen illustrations where, and just content in general, where IUL agents will say or show the client only paying into the policy for 5 years, 7 years, 10 years, whatever. And then it shows no more premium payments being made. Well, that doesn't mean the policy's paid off. Okay. So on a whole life insurance policy, when you don't see any more premium payments, that usually means there's a reduced paid up, or if it's a 10 pay, it's kind of like a 10-year mortgage. And that in that example, once it's like you could pay off a whole life insurance policy, never owe premium payments ever again. Okay. What that means is you'll never get a bill from the life insurance company ever again. With an IUL, that can absolutely happen. And oftentimes does. I see it a lot more with like traditional universal life products right now. The reason is because IUL hasn't been around long enough for this to happen to people. But index universal life insurance Did you hear what I just said? Universal life insurance. It's literally the same exact thing as regular universal life insurance. The only difference is the crediting strategy, the interest crediting strategy. That's the only thing that's changed, but it's still a universal life insurance product. What does that mean? It is built on annual renewable term. That means your cost of insurance goes up every single year. A premium payment is always going to be due every single year. Now, you could not pay into the IUL, but that doesn't mean the premium is not due. And if you don't manage your net amount of risk, and as you're getting older, that cost of insurance can really start to eat away at your cash value. So you have to be very careful with that. I would say that's not a benefit. And this is extremely misleading because it suggests that you never have to make another premium payment ever again in an index universal life policy. And that's not the case. If your policy does not perform, and your cash value is just getting decimated by cost of insurance, God forbid you have participating loan balance right now in retirement that is not doing so good, right? And you don't have enough cash value to pay or to cover the cost of insurance for that year, you will get a bill that to pay a premium, to make a premium payment so that your policy doesn't lapse. That's how universal life insurance works. So this is beyond misleading. So this is just incredible. Whole life insurance grows 2 to 5% only, but company buys additional insurance. Again, this makes no sense. Like, dude, have ChatGPT write this out for you next time so it actually makes sense when people are reading it. This statement just doesn't make any sense. But I see what he's trying to say. So typically, really the only actual argument that people have against whole life insurance when comparing it to IUL, it always comes down to the rate of return, even though it's very likely, in my opinion, that just looking at numbers, that whole life custom designed high cash value dividend paying whole life insurance will actually outperform index universal life insurance over the next decade. It's going to be really interesting to see. But if the only thing you have is rate of return, like, we don't set up life insurance policies to get high rates of return. We're going to get a safe bond-like rate of return. Okay, so typically these policies will net 3 to 5%. That's net of all cost of insurance, fees, commission, everything. All right, 3 to 5% tax-free compound growth for the life of the policy. All right, when set up correctly, to me, that's a really good savings vehicle. It's a really good bond alternative, especially considering all the other benefits that you get, the tax advantages, the death benefit, the living benefits, right? It's a really good bond alternative. Okay, but so to me, that's good, safe money. And then, we maybe take a little bit more risk in the markets. I like Bitcoin, whatever works for you, that's fine. But then look at this. This is I don't even know how this gets past compliance. I'm glad I'm doing a video on this to get this on the record, because maybe this will be useful in a lawsuit one day. I don't know. But this guy's saying last 66 years history average, it's historical average, 7.5%. That's just a made up number. Like, where are you getting that number? He's probably looking at the S&P 500. But guys, the S&P 500 has far less to do with the actual performance of an IUL than people like this make it out to be. Do you know why? Because you're not actually invested in the S&P 500. There is a call options strategy. There's just an option strategy in general. And God forbid you're using one of these volatility controlled indexes. There's futures and options. It's really complicated. And it's also very expensive. Options have a cost, and that cost fluctuates constantly depending on the economic environment, interest rates, all that stuff. So volatility in the market, right? So there's an options budget that fluctuates. A cost, but then there's also an options budget that gets generated by the general fund of the life insurance company so that they can implement this options strategy, and that fluctuates as well. So those are actually the primary factors of the performance of an index universal life policy, in addition to the fact that the life insurance company can change whatever they want or whatever they need to with regards to the performance of the policy. Cap rates, participation rates, spread charges. I mean, 9 times out of 10, cap rates and participation rates are coming down a couple of years after you buy your policy. That's going to have a massive negative impact on your policy long term. So there's no IUL that I'm aware of doing 7.5%. That's almost mathematically impossible when you have a 10, 11, 12% cap rate, that especially when it gets lowered over time to a 7, 8, 9% cap rate. Like, how are you going to average 7.5% in an IUL if your cap rate and participation rates get dropped? And then, I'll hear people say, we'll just do an uncapped index. Well, they can adjust participation rates on that. Like, is your participation rate in that uncapped S&P 500 index, is that guaranteed for the life of the contract? I bet you it's not. Ask your agent that. So this is incredible. He said IULs average 7.5%. Guys, IULs haven't even been around for 66 years. The first one came out in 1997, I think it was. So they're like barely 30 years old. So what are you talking about, dude? This is hilarious. Whole life insurance, if a client borrows money, interest rate is at 5% or 8%, 5 to 8%. So this is actually true. There is a cost to borrow against your whole life insurance policy, but I've done videos on this. I don't want to get into this too much. This is not necessarily a bad thing. Oftentimes when IUL agents are pointing this out, they're talking about it with regards to taking out tax-free or like generating tax-free retirement income in the form of policy loans, which I'm not a fan of at all. But with that said, you can do it. You need to make sure you're working with the right person and you're conservative about it. All right. Make sure that your policy has matured enough. It's efficient enough to be able to handle taking out income like that. I'm not a fan of it. Again, I prefer, if you're going to do it, withdrawal up to basis, maybe turn your dividend to paid in cash and do that. Is it going to be as much as what you're seeing on an IUL illustration? No, but at least it's going to happen, because what you're seeing on the IUL illustration is just fantasy land, guys. It's smoke and mirrors. It looks really good on paper, but what's going to happen in reality? All right, that's what you actually need to ask yourself. So this can absolutely be managed right here. This is not a deal breaker whatsoever. I pay this right now. I just borrowed against my whole life policy about a month ago at 6%. I lent it out at 13% plus 1 point on a real estate deal. So I'm implementing the infinite banking concept with it. And this is what banks do like all the time. So this is not a deal breaker at all. All right, index universal life, 1% for the first 10 years for standard loans and 0% after 11 years for preferred loans. I would need to see more specifics on this. Typically, the 0% is a wash loan. What that means is when you borrow money out of your IUL with a wash loan, that money is no longer earning any interest. If you do hit your cap, or like interest is credited to your policy that year, whatever amount of money that you have borrowed in the form of a wash loan is not going to get that interest crediting. Then there's the participating loan, which it would get the interest crediting that year, but now you're paying 4, 5, maybe 6% on that participating loan, just like you would with a whole life policy. So yeah. And with that said, again, I would need to see more specifics on this, but the interest rate on a whole life policy is not a deal breaker. Premium is higher for the same face amount. Premium is lower for the same face amount. This is true in the beginning, because again, IUL is built on annual renewable term insurance. Term is always going to be cheaper in the beginning than whole life insurance, but that's because whole life insurance, the cost of insurance is leveled out throughout the entire policy. And so like you're not going to have that rising cost of insurance that is due every single year. It's guaranteed to, like everything is guaranteed to stay level throughout the policy. So it's going to be more expensive on the front end. It's going to be less expensive on the back end. That's how it's leveled out. So you will get more death benefit up front for the index universal life policy. But again, that's short-term thinking in my mind. I don't care if I get a little less death benefit. I want something that's going to be there. I want something that's reliable, that I don't have to stress about, that I don't have to worry about cap rates and participation rates and spread charges and what are the market doing, what are options doing, and blah, 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 blah. I don't want to have to manage an amount of risk. I don't want to do any of that. Now, if you want to roll the dice and take all that risk for potentially a little bit more percentage gain over the life of the policy than whole life, then be my guest. But to me, it's absolutely not worth it. Not to mention, like I said before, the death benefit of your whole life policy is going to increase throughout the life of the policy when you set it up like that. Like, again, we're not talking about traditional final expense whole life, talking about custom designed, high cash value, dividend paying whole life insurance. All right, after borrowing money, if the client dies, beneficiary only gets face amount minus borrowed money. Yeah. With an IUL, after borrowing money, if the client dies, beneficiary gets full face amount of cash value minus borrow. Okay, so he's kind of going back to the same point here, that they get both the cash value and the face amount. I would have to see specifics on that, but I mean, he did say minus borrowed money. That's always going to be the case. If you have borrowed money, if you have an outstanding policy loan, when you pass away, that will be deducted from the death benefit, and that goes to the benefit. Whatever's left goes to the beneficiary's income tax rate. This is incredibly misleading right here, because I have all three of these, my friends, and both of my whole life policies. So whole life insurance, apparently, so what we're talking about here are the living benefits. This is, so if you were to get diagnosed with a chronic, critical, or terminal illness, like he has listed out here for IUL, then you could actually access a large portion of the death benefit to get whatever treatment you want, to really do whatever you want with it. It really does give you a lot of control over your medical directive. So it's a really powerful benefit of life insurance. I don't know why he's suggesting that whole life insurance only has terminal illness riders. That's absolutely not true. There might be some companies that only offer that, but there's plenty of companies that offer all three of these. I have all three of these in my policy. So I don't know what you're talking about, dude. This is just a straight up lie. Oh man, that's frustrating. As per rule of 72, if you invest 10,000 at age 29, 2% interest rates, which these policies typically do 3 to 5%. Mine does my first one does about 4%. So that's already extremely misleading. At age 65, it compounds to $20,000. Okay. Again, I want to reiterate, you don't invest into whole life insurance or any type of life insurance for rate of return. It's not an investment. It's a very efficient savings vehicle. It's really good for creating a strong financial foundation, provides a lot of different benefits, provides liquidity. So if you're a real estate investor, business owner like me, we can deploy that capital to get even higher rates of return. Like, that's where we actually get our rates of return. It's not within the life insurance policy itself, guys. We're not trying to take a bunch of risk inside of our life insurance policies. Okay. As per rule of 72, if you invest 10,000 in an IUL at 29 with an 8% interest rate at 65, you have 160,000. IUL agents love to make up random numbers. I'm sorry. Where are you getting the 8% interest rate? What IUL has done 8% for 30 years, 35 years, whatever? Show me that. Because if you can't, you are just making stuff up, buddy, just to sell this crappy, fundamentally flawed product. I'll go ahead and wrap up with this. Okay. This is the kind of crap I want you guys to be careful with. This is one of the reasons I started my channel, is trash like this that we just went through. This is the kind of crap that almost got me to buy an IUL before I understood how it actually worked. These agents, they love to talk about how amazing it is. They never talk about the risks, all the things that can be changed by the life insurance company, all the things that can go wrong. And they just make it sound like this amazing unicorn financial product that's going to solve all of your problems, fix all your ailments, and it's going to make you a millionaire by the time you're 65. It's just ridiculous. Ask yourself this, why are there so many lawsuits, class action lawsuits popping up around IUL right now? You can check my channel. I've done multiple videos on this. NLG, Midland, there's another one coming out really soon, which I can't say what it is, but I cannot wait until it's filed. It is going to be epic. But it's also really sad, because it means that there's a lot of people getting taken advantage of by these products. And here's the thing, it's not even really the product. It's the misleading marketing around it. Crap like this. Even though I'm not a fan of IUL whatsoever, okay, it doesn't fit my investor DNA, even though it's not investment, but I'm saying where I put my money is just not in alignment. That doesn't mean there's not a place for it. I've never really heard of a really good reason to put money into an IUL or to buy one. But that doesn't mean that doesn't exist. And that doesn't mean that people shouldn't buy it if they understand it, if they know how to manage it, if they're working with the right people, and you are managing your expectations. Okay. But this is just wrong, because it makes it seem like it's something it's not. And what that leads to is people making decisions, like major life-changing financial decisions, long-term decisions, based on false and inaccurate information. And that is just like beyond unethical, man. This is just so frustrating. So anyways, I hope this helps, guys. This is, like I said, one of the main reasons I started my channel was to protect people from this crap, so that you just make sure you know what you're looking for, what questions to ask, what to look for, what to be careful of, and so that you can make the best decision for yourself, guys, because this is the wild west in personal finance right now with this IUL crap. It's just insane. So anyways, hope you guys are crushing it, and I will talk to you in the next one. To your success. Matty Ice is out.